Hi everybody, and welcome back to video number 8 in chapter 16. And when we left off, we were looking at transferring debt securities from available for sale to held to maturity. And here our measurement basis is going to be security is transferred at fair value at the date of transfer. Similar to how we did the transfer from held to maturity to available for sale. And then for our measurement basis, we're going to transfer it at fair value at the date of transfer. And then for the impact of transfer on stockholders' equity, the unrealized gain or loss at the date of transfer is carried at a separate component of stockholders' equity and is amortized over the remaining life of the security. And there's no impact of the transfer on net income. And if we look at this asterisk here on the impact of transfer on stockholders' equity, that assumes that adjusting entries to report changes in fair value of the current period are not yet recorded. And then on our second asterisks here, the transfer from held to maturity to available for sale, according to GAAP, these types of transfers should be rare. And at least in my experience, I've never had one. Okay, so now, if we look at the summary of treatment of major debt and equity securities, here we have trading is our first debt classification, and the valuation approach and balance sheet reporting is at fair value, current assets. The income effects are that the interest is recognized as revenue. Unrealized holding gains and losses are recognized in income. On available for sale classification, the valuation is at fair value, current or non-current assets, and then interest is recognized in revenue. Unrealized holding gain and losses are not recognized in income, but in other comprehensive income. Then in the held to maturity classification, the amortized cost is how we value that, and that's either in current or non-current assets. And the income effects are that the interest is recognized as revenue. Those are our debt classifications. We also have equity calculations, and we split those between holdings of less than 20%, where we value them based on fair value, current or non-current assets. Dividends are recognized as revenue. Unrealized holding gains and losses are included in income. If the holdings are between 20% and 50%, we use the equity method of valuation. Investments originally recorded at cost with periodic adjustment for the investor's share of the investee's income or loss, and decreased by all dividends received from the investee subsequent to the date of the investment. And the income effects are that the revenue is recognized to the extent of the investee's income or loss. Now, if we hold more than 50%, now we are in full control of that corporation, and we consolidate the financial statements. The parent and subsidiary company income or loss is combined. If it's non-marketable, then we're just going to reflect it at cost, and dividends are going to be recognized as revenues. And they do have one asterisk item here, and the companies have the option to report financially. Let's go under classification here. The companies have the option to report financial instruments at fair value with all gains and losses related to change in fair value reported in the income statement. And if the company chooses to use the fair option for some of its financial instruments, these assets and liabilities should be reported separately from other financial instruments that use a different valuation base. All right, we'll move on to describing the use of and accounting for derivatives. You may be familiar with the Enron situation, and this is where a lot of the problems arose. Okay, defining derivatives. What are they? These are financial instruments that derive their value from values from other assets, such as stocks, bonds, or commodities. There's three different types of derivatives. We have financial forwards or financial futures. We have options and we have swaps. Okay. Who uses these derivatives and why? Commodity prices are volatile, as I think everyone knows. They often depend on weather, crop production, especially if you're a food manufacturer, and just general economic conditions. To plan effectively, it makes good sense to lock in specific future revenues or costs in order to run their businesses successfully. So, the speculator, who may be in the market for only a few hours, hopes to offset a forward contract to their benefit. The arbitrators or arbitrageurs attempt to exploit inefficiencies in the market. They seek to lock in profits by simultaneously entering into transactions in two or more markets. This is very sophisticated current exchange trading normal. All right, so the basic principles in accounting for derivatives. Number one, we recognize derivatives in the financial statements as assets and liabilities. Number two, we report derivatives at fair value. Number three, we recognize gains and losses resulting from speculation in derivatives immediately in income. And number four, we report gains and losses resulting from hedge transactions differently depending on the type of that hedge. I suspect this terminology is all new to you, so this may require a little bit of additional study to really understand how this all works and have it be a little bit more understood. So here we have on July 2nd, 2025, we're going to assume that the company purchases a call option contract from Baird Investment Company on January 2, 2025, and it gives it the option to purchase Laredo stock at $100 per share. If the price of Laredo stock increases above $100, the company can exercise this option and purchase the shares for $100 per share. But if Laredo's stock never increases above $100 per share, the call option is worthless. The contract gives it the option to purchase 1,000 shares, and that's referred to as the notional amount of Laredo stock at an option price of $100 per share. The option expires on April 30th, 2025. The company purchases the call option for $400 and makes the following entry on January 2, 2025. We're going to debit the call option for $400 and credit cash for $400. So the derivative financial instrument here, the payment is referred to as the option premium. And the option premium consists of two amounts. The option premium is the intrinsic value plus the time value. Okay, so the option premium formula for the intrinsic value. The intrinsic value is the difference between the market price and the preset strike price at any point in time. It represents the amount realized by the option holder if exercising the option immediately. On January 2nd, 2025, the intrinsic value is 0 because the market price equals the preset strike price. Now, the time value refers to the option's value over and above its intrinsic value. The time value reflects the possibility that the option has a fair value greater than 0. How? Because there is some expectation that the price of Laredo shares will increase above the strike price during the option terms. As indicated, the time value for this option is $400. Okay, so at March 31, the market price is $120, and the time value to call the option is $100. So on April 16th, the price falls to $115 a share, and the time value of the call option is $60. So on March 31, 2025, the price of Laredo shares increased to that $120 per share. The intrinsic value of the call option is now $20,000. That is, the company can exercise the call option and purchase 1,000 shares from Baird for $100 per share. It can then sell the shares in the market for $120 per share. That gives the company a gain of $20,000, representing the $120,000 less the $100,000 on the option contract. Now on March 31, so remember this transaction here, it records the increase in the intrinsic value of the option as follows. It's going to debit the call option for $20,000 and credit the unrealized holding gain or loss dash income for $20,000. A market appraisal indicates that the time value of the option at March 31, 2025 is $100. The company records this change in value of the option as follows. So let's go back and look at that real quickly. And we are going to debit unrealized holding gain or loss this time by $300 and credit the call option for $300, representing the difference between $400 and $100. Now, the effect on the financial statements at March 31, 2025, they're going to report bullet point 1, a call option in its balance sheet at fair value of $20,100. Bullet point 2, an unrealized holding gain, which increases net income. And bullet point number 3, a loss on the time value of the option, which decreases net income. That looks like a good place to end this video. And when we return, we'll take a look at derivative financial instrument speculation. Until that time, bye for now.